Hello and welcome back to my channel. I am Christy Vann with Fantastic Finances, and on this channel I teach velocity banking. But today I wanted to bring on a good friend, Harrison George. He is with CMG Home Loans, and he is on here today going to explain to me directly what is the first lien HELOC product, also known as the all-in-one loan. I'm super interested in this because I myself did not even learn about this product until about 2 years ago, maybe. And, I have people coming to me all the time and they'll say, well, how am I going to get my mortgage into a line of credit? Or how am I going to buy a home if I can't have a mortgage? So, Harrison, you're here to answer that question. I know that when I learned about what the first lien HELOC actually did, I was amazed. I had no idea you could buy homes with these products, these tools that the bank offers. So welcome, Harrison. Thank you so much for showing up today.
Thank you so much, Christy. I really appreciate that. Yeah, so the product that we're talking about today is operational in all 50 states, but kind of wanted to give a little bit of background on myself, just so people can know who I am. Obviously, my name's Harrison George, and I actually live out here in Idaho. I have a couple people on my team that work for me to help us with not only this all-in-one loan, but we do all kinds of financing from normal conforming to FHA to VA to non-traditional financing like bank statement and DSCR loans and so on. And realistically, like you indicated just a moment ago, we're going to kind of chat a little bit about this all-in-one first lien HELOC.
Yeah, I'm excited about it because, like I said, the reason that I even came across your actual mortgage company was because I couldn't find anybody that worked in Texas. And I most of my clientele is in Texas. And so I was turning them away because I didn't have any idea that that would work there. But you have saved the day when it comes to the Texans.
Oh, yeah.
What is the difference between Texas and then, the other states that just offer the basic first lien HELOC?
Yeah, and so kind of just to give a general understanding of what the first lien HELOC is, and then I'll get into that is, so essentially the first lien HELOC broadly is essentially a checking account that is paired with your mortgage. So in an individual refinance out of their home, let's say that's a $500,000 valued home and they have a $100,000 balance, that individual would get an 80% line of credit on the value of their home. So in this instance, they would get a line of credit of $400,000. Of which they only owe $100,000. And because this loan is a HELOC, your payment on the home is only going to be based off of what you owe. So as this individual uses their checking account and deposits their direct deposit into it, or money from grandma, or $10 they found on the side of the road, all of that money gets applied towards your mortgage balance. And as you put money into your checking account, at the end of every day, it'll sweep against your mortgage balance, paying it down, and your payment is based off of what you owe on a daily basis. So as you can imagine, as long as you're spending less than you earn, your mortgage balance is slowly going to do this. And as it does this, your payment associated with each of those months that your balance is going down is also going to go down. So you're saving more money monthly, which helps you pay off your mortgage a little faster. So that's a pretty generic overview. There's a lot more to it, but to get into your actual question, the difference between the all-in-one in Texas and all-in-ones outside of Texas is that automatic sweeping function in the Texas properties is a little more different than in any other state. In every other state, it just automatically happens. Whereas in the Texas all-in-one, there's a limit on how much you're able to actually have come out of the account in any given withdrawal from your line of credit. If you had a $200 gas bill for, let's say, you couldn't just pull out $200 and go and pay that bill. So realistically, the way that this loan makes the most amount of sense is you try and consolidate all of your expenses into one single out-of-pocket day. On the 21st of the month, I've paid all my bills on my credit card 1, 2, and 3, and on that day, I'm going to pay off all $6,000 of that those debts that I have on a monthly basis. So that way, you can meet the minimum withdrawal, which is $4,000.
Okay, that makes sense. Okay, because I do hear that a lot, that you're only allowed to take 4,000 at a time. That makes sense. Okay,
it's a minimum of 4,000. It's
right.
Not at a time. So if you needed to pay $4,500, you could do all 4,500.
Right. but also meaning that if you only need $2,000 and you take the 4,000 withdrawal, you can turn right around and put back the other two,
Correct.
right? Okay.
Yeah. So the sweet functionality of this is a little different as well. You would need to move the money from the checking to the mortgage balance as your own individual self, as opposed to it automatically doing that. So there's ways you can kind of play around with it. There are, in my opinion, depending on what your monthly expenses are and so on and so forth, it may make sense to leave in about $4,000 in that account because life happens and you sometimes have other bills and other expenses that come up that you need to pull out. And if it's $200, moving out 4,000 and moving it back is,
Yeah. Okay.
I keep it simple, stupid. That's the kind of person I am.
Me too, me too. That makes sense. But outside of Texas now, you're talking about a sweep account that does everything for you, right?
I haven't logged in to pay a bill or do anything since the only time I log in is when I'm showing someone how to use the all-in-one.
Nice.
Unfortunately, my wife pays a lot of the bills out of it, but you can set direct deposit and auto pay and the whole 9 yards associated with this.
That's awesome. So let's talk a little bit about one, if you already currently have a mortgage, you can move the mortgage loan into this product, this tool.
Yes.
I love that. But you can also purchase a home with this. So tell me a little bit about how that process works.
If you've ever purchased a home, it's almost exactly the same as any other purchase. Now, there are some requirements with this product though. So you can purchase a home with this product with 10% down. Now you are going to experience higher costs associated with that. Kind of the sweet spot is really going to be that 20% down. And that's really going to be, those individuals that likely have the ability to show that they can save money and are already going to be a good fit for this product. That 10% down option is, hey, we're okay paying slightly more because we qualify for our old home and our new home. And once we sell our old home, after we buy the new home, we're going to stick in $400,000 and pay it down like crazy. That upfront expense is not that big of a deal. We need the simplicity. Grandma lives there, so on and so forth.
So that also means, though, if you have retirement accounts, am I wrong in thinking that if you have a 401k or you have a whole life policy or something like that, that it may count towards that 10%?
If they pulled the money out of those accounts and used it, yes, for your down payment. You couldn't just say, oh, I have this 401k and it has $200,000 in it. I want that to be applied to my mortgage balance. The only way you could do that is take it from that account and put it into this account.
Well, basically, though, if I'm understanding everything correctly, is even if you're pulling out of those accounts and putting it into this that you're talking about with the HELOC, you're still gaining the equity in your home, so you actually still have
the money
that available, right?
And there's certain scenarios where maybe it does or doesn't make sense to pull the funds out, and that's really like my favorite part about this loan is that it's just a math problem. So we either see that it makes sense or that it doesn't make sense. And sometimes the way that it goes from one side to the other is making a change in that person's life. Hey, you are currently spending way too much on your favorite shopping website, Amazon or whatever else you spend money on. It looks like you guys could dial some of that spending back, or you're going out too much. How can we help you save money? Because I know after talking with so many people, that people kind of get stuck in this comfortable bubble and nothing really needs to change because nothing's really going wrong. But when something goes wrong, it's a big deal. And now they're trying to dig themselves out. Well, what if you never needed to dig yourself out? What if you never needed to wake up at 2 o'clock in the morning, freaking out about finances because you're taking small incremental steps in the right direction instead of one-time attempts to take a massive step forward, but then falling all the way back to where you were just to get in trouble again. That's what we're trying to prevent.
Yeah, and I love that. I think that the HELOC really opens up options for people in so many ways. But, just the fact that that balance keeps coming down every time you transfer income into it, that alone, to me, makes the mortgage like, let's go with the HELOC if we can. That being said, what are the requirements or what qualifications do you have to meet to be able to even apply for the HELOC?
Yeah. So a moment ago, we kind of talked about down payment. So Texas does require for 20% down. Essentially, everywhere else you can do 10% down. Now, I'm just going to assume moving forward 20% so that we can kind of keep it easy, but you can do slightly less in other states.
Okay.
for primary residence, because this loan can be done on a primary, second, and an investment property, you're looking at 700 credit scores. For an investment property, you're looking at 720 credit scores. Now, the higher your credit score goes, the cheaper the costs associated with the loan changes. You're not going to see realistically any change in interest rate, but if the costs associated with the loan get cheaper, you could choose to find a lower margin option with this loan so that you would have a lower interest rate. So that's where we start playing with the specifics. So you have your credit score, you have your down payment, you have your reserve requirement. So we need to see, depending on what your debt to income ratio is, between 10 and 15% of your line of credit in reserves. So let's rewind a second. I'm just going to use easy numbers. You have $1 million primary purchase and you put 20% down, you have an $800,000 loan amount. If you needed to have 10% in reserves, you would need to have $80,000 in reserves. If you had to have 15% in reserves, you need 120. Well, what makes the determination? It's if your debt to income ratio is below 40%, then you need 10% in reserves. And if your debt to income ratio is between 40 and 43, then you would need 15% in reserves.
Okay, that makes sense. So for people who don't understand what the DTI is, or the debt to income, explain that a bit.
Yeah, so I mean, it's kind of right there in the name. It is your debt compared to your income. So if your debt associated with your life, now we're not talking about your car insurance, or we're not talking about your cell phone bills and so on. We're talking about your mortgage or any actual loans that you have, your credit cards, student loans, of course, and any potential, if you're buying a home and you're currently renting, then you would no longer have any rent that you would need to pay because you're basing it off of your new income divided by what your income is. So I have a $200 credit card payment, I have a $500 vehicle payment, and I currently have a mortgage payment, or I rent for $1,500. Well, we don't need the $1,500. We're just going to take the 500 and 200 and plus the current mortgage payment that you're buying and divide it by your income.
Okay, so that's simple. As long as your debt payments are around 40%, hopefully less than what your income is actually bringing in, what you're actually bringing in, then you're safe. And I think that's very simple because a lot of people just don't understand what the DTI is.
And it's not net income, it's gross. So if you're paid $25 an hour, 40 hours a week, you make $52,000 a year, we're using $52,000. We're not using, I declare this and I pay this in taxes and I'm in this state, so I actually it's $52,000.
Okay. All right. That is very good information. So I appreciate you sharing information like that, because the American people just have not been taught how to use a bank at all, much less what they require when they go in. I have people come to me and they'll say, I applied at this bank and they turned me down. And I'm like, if you are asking the right questions before you go to the bank, you would know not to even apply. So I think that that's good information. How do you feel when somebody comes to you and say, I send you a referral because somebody, they're wanting to look at this? What are the very first questions that you ask them when you have your consultation?
I ask them what questions they have first, because I don't know where they are in the process of understanding this product. Mm-hmm. Now, some people go, well, I've heard of it and here's some information and this is what I think and this is what I know. Great. Well, let's walk through it. You're right on this part. This is a little change. This is a little change. Here's where you're good again. And we just kind of understand it. Then we just start learning about them. Okay, well, what are we trying to solve? Why are you looking to do this product? Well, I have all this debt. I have all this equity in my home, this really, really low interest rate, but I have so much debt that I've accumulated that payment is far superior than my actual mortgage payment. Okay, well, let's walk through it. Let's see if it makes sense. Currently, you're spending this much, $1,000 in your mortgage and $3,000 in other debts. If you were to do this loan, you would be eliminating this $4,000 of money that you have outstanding right here, and your new expense would be $2,500. So right out of the gate, you're saving an extra $1,500. Does that make sense? Yes. Okay, well, how do I pay my home off in 7.5 years? Because that $1,500 plus whatever else you save on a monthly basis is going to your mortgage balance and paying it down. And as it pays it down, that expense of $2,500, which is including your mortgage payment, is now going to go from 25 to 24 to 23 to 22 and so on until you pay your home off, meaning you're going to save more money monthly. All of that sitting in your home and you just pay it off. So we're talking through a scenario, their scenario. I ask them what their value is, what they owe, and just trying to learn about them and communicate with them in their shoes because it's easier for people to understand their shoes.
And people don't understand. So I'm glad you take that time with them. I was thinking of another question because I understand that when someone wants to purchase a home, um, they may not have picked out the home yet. They just know they want to go with the HELOC. How do you determine, can you pre-qualify an amount or how does that work?
Yeah, I mean, essentially, they just send us a vial of blood. No, I'm just kidding. Essentially, yeah, we do pre-qualify them, just like any other individual. It doesn't cost any money to do a pre-qualification. In many instances, we can do a really generic pre-qualification without even running credit with a hard pull. Now, we will need to do a soft pull, but you fill out an application, you send us a couple documents. Oh, I'm a W-2 worker. Great. Send us your W-2s and your pay stubs just so that I can confirm, what was it 2 years ago versus last year? And is it in line this year? Because if some people may get large bonuses or people perhaps have had their bonuses removed. We want to make sure we're taking all of that into consideration so we can tell them accurate information.
Okay.
And then we just go, great. With your current debts that we can see, here they are. And the potential home you're looking at that you sent us examples of, you could qualify for this. And in fact, you could qualify for slightly higher. Or unfortunately, because of your current debts, that home you wanted or that you were interested in is slightly out of your qualification range. However, if we were to pay off these debts, if we were to be able to find a solution, this is how we get you into this home.
Wow. Okay. So you're the first bank that I have had tell me that. So that's good information.
Okay.
Because people want to know what they would qualify for first. So that's a good
Of
information.
course.
All right.
Yeah,
I mean, it makes sense to me too.
Yeah. Why? I'm going to make an offer on this place. I don't know if I qualify or not. That's kind of the first step.
Yeah. And my daughter's a real estate agent here in the state of Tennessee, and they will not even let them do an application for a home unless you have been pre-qualified for the amount that you're wanting to buy. So I am very glad to hear that. Okay, so when it comes to the mortgage, now I'm just going to this is going to be a large question, but you can answer it in simple terms. If a person is in a 30-year mortgage, what is your experience now? What is the average that they can bring that payoff down to? What do you basically look for with a person that's just transferring their current mortgage into this line of credit and say they have, 26 years left, which that seems to be my normal client. They're about 26 years left on that mortgage. How often and what time limits, I guess, do you see somebody bringing a 26-year mortgage down to in just based on your experience?
Yeah, so that's where when you say 26 years, they bought a home in 2021, right? They have an interest rate between 2 and 3.5, let's just say, for just simple communication. At a 2.75 30-year mortgage, or just about there, what you spend about 50% of what you borrow in interest. So if that person has a $300,000 mortgage, they're going to spend about $150,000. Sure, it sounds a heck of a lot like I'm not paying 2.75% in interest. Looks more like I'm paying 50% in interest. And that's because the amortization schedule is super skewed towards helping banks. Now, this product essentially allows for people to pay their home off in those situations. If we see that they're paying their home off in 10 or 12 years and they're saving, $20,000 or $30,000 in interest or $40,000 in interest, I think that there is a value add in that, because you could imagine over the next 7 to 10 or 12 years, your pay is probably going to adjust slightly or hopefully go up over that time frame. So your payment's all the expenses are kind of relatively going to stay the same, but your income should be doing a little bit of this. So over time, that payoff will actually increase. Now, we don't want to make that assumption. And that's kind of where it's, hey, does this make sense to you? If you went from 26 years to 12 years and you were going to spend $150,000 in interest, and now you're going to spend $120,000 in interest, and let's take into consideration, I'm just going to use a round number here, you're going to spend $10,000 to get into this loan. So you're really at $130,000. Is $20,000 enough for you? Well, currently, this is where our scenario is. In the next 12 months, this is probably going to be where it is. I get a raise every year. Well, how much is the raise? Okay, well, My raise is $2 every year. Well, let's put that into the simulation. That changes your payoff, changes what you spend in interest, changes the answer on maybe it doesn't make sense to go to an all-in-one, or yes, it makes sense. I pay it off in 8 years. I want to buy a rental property. I want to buy a new truck. I need to pay off my bills. Understanding that person's scenario is understanding on whether or not it makes sense for it's like it really has to be a personalized individual. Does this make sense for you? So many people say, I have a low interest rate, that interest rate's too high. And I go, this loan's not about interest rate. This loan is about the most important part of this loan is how much you're able to save every single month. And if you have increased of earning potentials over the next several years, this is a conversation you should have, because many people I talk with, even though this loan at the interest rate is in the 8s today in December, this loan has many people experience an effective interest rate, which is how we kind of compare it to a 30-year mortgage, below 2%, meaning that they would need to get a 30-year mortgage today at an interest rate below 2% to be equal to the all-in-one, whose interest rate today is in the 8% range.
Wow, that's great information. That is something I wasn't even aware of. I just know that when I run numbers with someone, and especially at the interest rates that mortgages are today, so over 7% is a lot of what I see. There's no comparison. The HELOC is almost always going to be a 7-year payoff around that time from compared to a 30-year mortgage. And that is insane to me. And people do not understand it. And I feel so sad. I have a video where I say I want to get in a fetal position on the floor and cry with these people because their wealth is literally being stolen and they don't even know it. They really think they got the deal, you know? So I'm here to educate people, and you're obviously here to educate people on the better way to buy the home. One major question that I get and concern from everybody I talk to about the HELOCs is the danger. That's the way but that's dangerous because I'm putting my home's equity at risk. Share how you feel about that just a little bit.
I kind of completely disagree, whether it's for the old, first and foremost, this product is not meant for everybody. I hear it's too good to be true, so what's the catch? Almost on a daily basis. And it's not too good to be true. It's just that this loan is only really geared towards certain individuals. People that are saving 15+% of their net income on a monthly basis certainly is a conversation that you should be having. Now, it depends on where your interest rate is. But realistically, you're talking about, I'm putting all my money into my home equity or my home value. Well, this line of credit is your bank account at the end of the day. Now, historically, we have seen major events take place in the United States where values went down like crazy. This loan has been out since 2006 in the United States and has been very, very popular over in Europe and Australia. They call them sweep or offset accounts. We haven't, unless if there's a specific reason, because there have been certain reasons. Hey, you haven't made a deposit for 48 months. What's going on? Your balance is getting closer to the top. You want your bank to be curious about who's not making and being responsible about it. But when we saw those values go down like crazy, 15 years ago or so, we didn't see these lines of credit go, oh, here you go, you're getting screwed now. All the money that you put into this is now gone. I mean, it is still your money at the end of the day. And so
that's awesome.
And the cool thing is that when thinking about, oh, well, is it FDIC insured? Yeah, well, the bank's FDIC insured, but if you had a $500,000 balance on your home and you paid it to zero, and then you saved $250,000, your $250 is secured by the FDIC, but your home is securing the value of the other $500,000. So in my opinion, you actually have broader security of your money because it's tied to something. It's not just sitting in an account.
I agree. And, now the second position HELOC, we did see those frozen back in 2008, 9, 10. So there is a difference in what position that HELOC sits in as far as I'm concerned. But, the point is that, like you said, your home is the security. So if you're not being foolish with these lines of credit. Now, I'm going to be real that I have clients that do not need to be in a HELOC at all. They don't need to use that tool because they think, oh, wow, I've got $50,000 available in this line. I can buy that new car I wanted.
Yeah.
I don't like that. And I don't use mine that way. And I tell people, hey, I have $100,000 sitting available right now and have for a long time. The point is that you have it available for what you need it for in the future. There's all kinds of things of value that you can do with your equity that's just going to increase your wealth. So that's kind of what I like to see the HELOC used for. Debt elimination or acquisition of additional properties, to me, is great ways to use this line of credit.
And you can even, sorry to interrupt, but you could also use it for your cash value, your whole life policies. You could say, hey, instead of doing a monthly deposit, I'm going to just do a lump sum at the beginning of every year. And I'm kind of working through the math of it right now. And so once I get that figured out, I'll share it with you. But after listening to Chris Noggle, who obviously I really, really just love his information, my thought process is, okay, well, after a certain amount of time, if you were to use the equity in your home to begin this policy, after a certain amount of time, do you potentially have enough available cash value to pay off the mortgage and then use the available line of credit from the mortgage to then make the payments back into your whole life policy so that you could pay yourself off? And you could change a payoff from, oh, that's going to bring us to 12 years. Yeah, but in 8 years, you're going to have $400,000 of cash value or whatever the number is. Pay your mortgage off and then pay yourself back to the cash value. So now you're not paying the bank interest, you're paying yourself the interest, and you just saved 4 years. You can go and retire because you thought you were going to retire at 71, and now you're going to do it at 65. It gives you that flexibility.
Oh, it's beautiful. And it's so crazy you brought that up because I was doing an interview like this with Chris Noggle yesterday morning, and we went through the scenarios of that. Before I learned how to use a line of credit, I never could have done the deposits into the whole life. When Chris and I ran the numbers yesterday, it's a no-brainer that
The banks don't like it.
funding it.
Yeah, the banks don't like it because you're taking away interest from them. I mean, this all-in-one product is, to my knowledge, the only consumer benefiting product as opposed to bank benefiting product. 30-year mortgage, the amortization schedule is crazy. You're like 14 or 15 years in before you spend more in principal than you do in interest.
Exactly.
This one flips it around. Yeah, we're making less money with this product. We, the bank, right? But this gives us ability to put our foot in the door and help people that otherwise are going to be spending unnecessary dollars and cents. And that is going to build a relationship with the person, whether they know it or not. Hey, I'm thinking about starting a business. Wonderful. How can we help you? I need a business. I need funds for my business. Hey, I'm thinking about, I need to buy a new vehicle. Can you guys help me with that? Yes. So it's opening up the door to say, hey, we're going to be that stop for you to come to, and we're showing you how you can save money throughout the entire process.
I love it. I love it. I think that it is a game changer for people to not only get their home paid off, but to help them build wealth in ways they never even thought was possible. I'm speaking for the American people that have been in my position to where I never dreamed I would be able to leave my children the money that, I have set aside now in the whole life policies. Things like that, investments that I never dreamed I would be able to make if it had not been for using the HELOC to do that. Mm-hmm. So I am super appreciative that you feel the same way, and that, we're showing the people there is a way that you can get out of that 30-year mortgage. I talk to people every day. They had no idea. They had no idea there were other options. So I appreciate you coming here today and having this conversation with us. I just think that it's wonderful what you do, the opportunities that you give people, and the conversations that you will sit down and have with people to help them understand how this tool may be more than they ever dreamed possible. I just appreciate you doing that. I love working with you. And I think that we're really going to help a lot of people completely change their financial outlook. So I appreciate you.
Thank you so much, Christy. I appreciate that. Thank you so much for having me.
For you guys that are watching this video and you want to know more information, I am going to have a link in the description of this video where you too can reach out to Harrison and have a conversation. He has a team that will answer your calls, work with you, get you scheduled for a consultation, just so you can see if you qualify for this tool. Even if you want to qualify, they're going to go through the scenarios that you are currently in to see if this is of value to you. So I appreciate you watching today. If you have any questions or comments, please leave them below. I'll be glad to answer them. I do look at YouTube every day. I want to read your comments, and I appreciate how kind you guys are towards me and the channel and what you're learning here, because I only want to help you to find the financial peace that you're looking for. I appreciate you, and I look forward to seeing you in the next video.